Picture this. It's 2021. You've just closed on a brand new two-bedroom condo in downtown Toronto. You paid $800,000 for it. A stretch, yes, but you've done the math. At peak Airbnb occupancy, this unit would gross $4,000 a month. The mortgage? $3,800. That's a $200 monthly profit, practically free real estate. And in 5 years, the property would be worth $1 million, maybe more. You'd crack the code. Passive income, financial freedom, the dream. That dream, for tens of thousands of investors across Canada and the United States, is now a nightmare. And I don't use that word lightly. Today, that same unit in Toronto isn't earning $4,000 a month on Airbnb. It's earning closer to $2,500, if you're lucky, if the market is playing ball, and if the regulations haven't already wiped your listing off the platform entirely. Meanwhile, that mortgage hasn't moved. It's still $3,800 a month. You are now bleeding over $1,000 every single month, and there is no exit in sight. U.S. average Airbnb occupancy has collapsed from above 60% at its pandemic peak to just 50% by spring 2025, a 12 percentage point freefall. This is not a story about a minor market correction. This is a story about a structural collapse driven by oversupply, rising mortgage rates, and a regulatory hammer that governments on both sides of the border are swinging harder than ever before. In the next 20 minutes, we are going to tear this apart, number by number, law by law, and market by market. We're going to look at Vancouver, Toronto, and New York City. We're going to follow the money, or rather the disappearance of it, and we're going to ask the question that every Airbnb investor in North America is losing sleep over right now. Is this bust just the beginning? Let's start with the raw numbers, because the numbers are brutal. At the height of the pandemic travel boom, roughly 2021 and into 2022, short-term rental platforms were printing money. Domestic travel exploded. Occupancy rates for Airbnb listings across the United States climbed well above 60%. Daily rates spiked. Revenue per available room, what the industry calls RevPAR, hit all-time highs. For a leveraged investor, it genuinely looked like a golden era. But today, U.S. average occupancy is down to 50%. That is not a small decline. A 12 percentage point drop in occupancy sounds abstract until you translate it into actual dollars lost per host. In an oversupplied market, that drop represents weeks of empty calendars, thousands of dollars of lost revenue per quarter, and the slow unraveling of a business model that was, frankly, thinner than it looked. Now let's get specific, because the national number only tells part of the story. The real pain is concentrated in Canada's two biggest markets, Vancouver and Toronto. In Vancouver, one 2025 dataset shows the average monthly revenue per Airbnb listing, sitting at roughly $2,592 per month. Average occupancy in that market has slipped to around 69%. That might sound acceptable on the surface, but here's what matters. The average daily rate has been compressed down to just $132. Compare that to 2021 and 2022, when daily rates in Vancouver were substantially higher and occupancy was consistently above 80%. A separate 2025 report estimates a typical Vancouver short-term rental now earns about 61,000 Canadian dollars per year. But critically, it emphasizes that new supply and competition have relentlessly compressed RevPAR compared to those peak season rates. And that RevPAR compression is the key concept we need to unpack. Revenue per available room is the metric that strips away the hype. It tells you, for every night your unit could have been rented, how much did you actually earn? When occupancy falls and daily rates fall simultaneously, RevPAR gets crushed from both sides. You're earning less per night, and you're having more empty nights. It's a double-barrel hit on your income statement. Now move east to Toronto, and the picture gets even darker. In 2022, Toronto's average Airbnb occupancy was measured at 23.1%. The momentum was building. But by 2025, the data tells a completely different story. Toronto area Airbnb occupancy has collapsed back down to approximately 18%, with RevPAR sitting around $153. Think about what that means. Even at peak booking rates, a Toronto host is seeing their unit empty for more than 80% of nights. The math of the business model starts to dissolve at that point. Nationally in Canada, the picture reinforces this. Back in 2020 and 2021, Canadian hosts were generating about $430 million in total Airbnb revenue, averaging roughly $5,300 per listing. By 2023 and 2024, that per-listing average had flatlined and in many urban markets was actively declining. But here's the thing, the market didn't just soften on its own. It got help, government help. And what legislators decided to do next is what truly shocked the industry. Governments don't usually move fast. Anyone who has watched a city council debate a zoning bylaw for 3 years knows this. But when it comes to short-term rentals, something changed. The political pressure became impossible to ignore. Housing costs were spiraling. Long-term rental vacancy rates in cities like Vancouver were below 1%, and a growing body of academic research was directly linking the spread of investor-owned Airbnbs to housing unaffordability.
The response, when it finally came, was not a gentle nudge. It was a sledgehammer. On May 1, 2024, British Columbia implemented the most sweeping short-term rental restrictions in Canadian history. The cornerstone of the new law is a province-wide principal residence requirement. Under this rule, a host can only list a property on a short-term rental platform if that property is where they physically live for the majority of the year. There is one carve-out. A host may also list one secondary suite on the same property. That's it. No more running a portfolio of 5 condos on Airbnb. The law applies in every BC municipality with a population over 10,000 people. The provincial government's own estimates suggest these new rules would free up as many as 19,000 housing units for long-term rental, units that had been functionally removed from the housing supply and converted into boutique hotels for tourists. But what teeth does this law actually have? The answer: significant ones. Municipal bylaw violations now carry fines of up to $3,000 per day per violation. Read that again, $3,000 per day. If you are a non-compliant host running an unlicensed Airbnb in Vancouver, every single night your listing stays live is potentially another $3,000 penalty. Provincial enforcement units can assess additional penalties up to $5,000 per day. And for corporations or digital platforms that fail to remove non-compliant listings, the fines can reach $10,000 per day. This is not theoretical risk. Enforcement teams were stood up alongside the legislation. The compliance pressure was immediate and real. If BC's approach was aggressive, New York City's was nuclear. Local Law 18 of 2022 took full effect in September 2023, and it didn't just regulate the Airbnb market in New York, it essentially ended it. The law has 2 core requirements that work together to make most Airbnb listings legally impossible. First, every host must register with the city. Second, and this is the killer, the host must be physically present in the unit during any stay of fewer than 30 days. You cannot rent out your entire apartment while you're away. Full stop. You can rent a room while you sit in the living room. That's it. Let that number land for a moment. 90%. New York City went from approximately 22,000 active Airbnb listings in August 2023 to roughly 2,300 by early 2024. In the outer boroughs, the collapse was equally staggering, from around 17,000 listings down to approximately 1,400. Airbnb itself published these numbers. This was not a slow attrition. It was an overnight wipeout. Unregistered short-term rental transactions can now attract fines of up to $5,000 per violation. The city has already filed its first lawsuits under Local Law 18. This is an active enforcement regime, and it is working exactly as intended. The regulations killed the revenue. The revenue collapse triggered the mortgage crisis. And what happened next, the math of being a trapped, over-leveraged Airbnb investor in 2024, is something that will genuinely make your stomach turn. I want you to meet a composite investor. He doesn't have a name, but he has a story that thousands of real people across Toronto and Vancouver are living right now. In 2022, he bought a 2-bedroom condo in Toronto. Purchase price, $800,000. He put 20% down, that's $160,000 of his savings. That leaves a mortgage of $640,000. At a fixed rate of 6%, well within the range of what Canadian investors locked in during 2023 and 2024, his monthly payment comes to approximately $3,800 per month, not counting property taxes, not counting condo fees, not counting insurance, just the mortgage. Here was the bet. At peak 2021 occupancy in Toronto, that unit could reasonably gross between $3,500 and $4,000 per month in short-term rental revenue. After Airbnb's fees, cleaning costs, and maintenance, you might clear enough to cover the mortgage. The thesis was never really about monthly cash flow anyway. It was about capital appreciation. Toronto real estate goes up. You hold it for 5 years, you make $200,000 in appreciation. The monthly grind is just the cost of holding the asset. The problem is that both sides of that equation have now moved against this investor simultaneously. On the revenue side, Toronto area Airbnb occupancy has fallen to around 18%. That $4,000 monthly gross has, in many cases, been compressed to somewhere between $2,500 and $3,000 per month. Net operating income on a well-run unit might now come in at $2,000 per month. Against a $3,800 mortgage, this investor is underwater by $1,800 every single month. And the mortgage rate environment doesn't offer any near-term relief. For investors in Canada and the United States, new 5-year fixed mortgage terms currently sit roughly in the 5 to 7% range. Compare that to the 2 and 3% environment of 2020 and 2021. The carrying cost of debt has effectively doubled. The monthly payment that once seemed manageable now feels crushing. One particularly illuminating case study documented in public real estate commentary shows a Toronto condo investor with monthly carrying costs of about $2,593 and monthly rental income of just $1,900, producing a negative cash flow of $693 per month every month. That investor had banked on price appreciation to bail them out. It hasn't come. Prices in the Toronto condo market have been flat to declining. Several Canadian market analysts have now published mortgage versus reality spreadsheets. The pattern is consistent. Outside of a handful of premium tourist pockets, leveraged Airbnb investors are losing money month after month with no clear exit ramp. And here is the psychological element that makes this trap so dangerous. These investors can't easily just walk away. They have $160,000 in equity locked up. They have credit ratings to protect. The pride and the financial exposure combine to keep them holding on month after month, bleeding cash, hoping the market turns. And every month they hold, they are deeper in the hole. But when the pain becomes unbearable, when the negative cash flow finally forces a decision, there is really only one option left. You sell. And when thousands of investors across Toronto and Vancouver reach that same conclusion at the same moment, something extraordinary happens to the housing market. By mid-2024, the number of active condo listings in Toronto had climbed to record highs. Not just high, record. The 12-month rolling average of active condos on the market reached its highest level ever recorded. Days on market extended, prices softened, and analysts began to identify a specific category of seller driving a significant portion of this new supply: investors exiting the short-term rental game. To understand the scale of what happened, consider this single data point. In July 2024, new condo listings in Toronto surged by nearly 34% compared to prior comparable periods. 34% in a single month. This is not the behavior of a healthy market absorbing normal turnover. This is the signature of forced selling. Investors who can no longer sustain negative cash flow deciding en masse that the exit is preferable to more bleeding. And it isn't just the market dynamics doing the pushing. In Toronto, a city-level audit and enforcement push in 2023 directly accelerated the exodus. Approximately 700 listings were formally revoked, and around 300 hosts were removed from the Airbnb platform entirely. For those investors, their expected future income from those units was erased overnight. Many of them immediately listed their condos for sale.
In Vancouver, the situation carries an additional dimension of pain that industry analysts call the double whammy. Not only did British Columbia's new short-term rental crackdown force thousands of listings off platforms after May 2024, but the Vancouver housing market simultaneously absorbed a record wave of new supply. 12,442 new condo completions in 2024 alone. Think about what that combination means for a condo investor in Vancouver. Your Airbnb revenue has been gutted by regulation. The value of your unit is now competing against thousands of brand new completions entering the market at the same time. And if you're trying to pivot to long-term rental to cover your costs, you are now doing so in a market flooded with new supply. The ground has shifted beneath every pillar of the original investment thesis. On the ground in neighborhoods like Kitsilano, broker commentary describes investors who were once pulling in $6,000 per month from their Airbnb listings being forced into an impossible choice: hold the unit at an ongoing monthly loss or list it at a market price that may be lower than what they paid. Many are choosing to sell, accelerating exactly the kind of price-depressing inventory surge that makes the condo market softer for everyone else. And while all of this carnage was playing out in the short-term rental world, one group of players was absolutely unambiguously winning. They'd been written off, they'd been called dinosaurs. But the hotels? The hotels are back, and they are feasting. There is a direct and measurable beneficiary of the short-term rental crackdown, and it is the traditional hotel industry. In New York City, the impact of Local Law 18 on hotel performance has been documented in extraordinary detail by real estate analytics firm JLL. Their analysis is stark. After Local Law 18 took effect in September 2023, NYC hotel RevPAR surged to levels that exceeded even the pre-pandemic 2019 benchmarks, specifically beating those 2019 levels by 15.2%. And JLL projects continued RevPAR growth running through 2024 all the way to 2028, with the short-term rental crackdown identified as a primary driver. The mechanism is elegant in its simplicity. JLL estimates that Local Law 18 effectively reduced New York City's short-term rental supply by approximately 70%, the equivalent of roughly 107 hotels going offline simultaneously. The demand for those nights didn't disappear. The tourists still came. The guests who would have stayed in an Airbnb simply had nowhere else to go but a traditional hotel. JLL estimates that hotels in New York City could gain up to 2.2 million additional room nights in 2024 alone as displaced short-term rental guests are funneled back into the conventional hospitality system.
This is the macro picture crystallizing in real time. When you remove a loosely regulated, investor-driven, tax-advantaged competitor from the market, the sector that competitor was disrupting recovers, and recovers fast. The hotel industry has been making this argument to regulators for a decade. Now they have the data to prove it. So where does this leave us, and what does it mean for the housing market in 2025 and 2026? The picture is complicated, but a few things are clear. The wave of sell-offs from distressed short-term rental investors is adding inventory to condo markets in Toronto and Vancouver at a time when buyer demand is soft and mortgage rates remain elevated. This combination, more supply, less demand, sellers motivated by financial pain, is a recipe for continued condo price softness in exactly the markets where these investors are concentrated.
For renters, the news is more nuanced. If BC's projection of 19,000 units returning to long-term rental is even partially realized, that represents meaningful supply relief in one of the country's tightest rental markets. The same dynamic applies in New York City, where those former Airbnb apartments, empty for 50-plus weeks of the year between tourist stays, are now theoretically available for actual residents to live in. For would-be investors who are still considering entering the short-term rental market, the era of passive income through leveraged real estate in a regulated urban market appears to be over, or at minimum, radically restructured. The days when you could buy a condo, list it on Airbnb, and coast on appreciation while the tourists paid your mortgage, those days are gone. The short-term rental market is not dead, but the easy money era is. Regulatory pressure is accelerating, oversupply is persistent, and rates remain high. The math has changed permanently for leveraged urban investors. Thank you for watching this full breakdown. Every single statistic, local law, and report mentioned in this video is linked down in the description below so you can verify the numbers yourself. If you are an Airbnb host, or if you completely disagree with my analysis, let me know in the comments. I read them all. Make sure to subscribe for more deep dives into the Canadian economy and real estate market. See you in the next one.